the gold supply is constant and the money supply keeps going up. So again, fifth grade math, you're going to get a larger and larger number of dollars per ounce in order to back up a higher dollar amount with the same amount of ounces. So it's about $23,000. So just to be clear, that's not saying that gold is going straight to $23,000 an ounce. That's saying if confidence in the dollar were undermined and you had to resort to gold to restore confidence, you can't just pick a number. If the number's too low, it's going to be highly deflationary, which is what happened in the late 1920s. So what would the number be? And the answer is around $23,000 an ounce.
JimRickards, an economist and author specializing in global finance and monetary policy, believes that gold could reach $23,000 per ounce if the dollar collapses and the gold standard is reinstated. While this price is not an immediate prediction, it highlights the importance of a sufficient gold price to restore confidence in the currency. In the current market, despite recent price fluctuations, gold continues to be seen as a store of value in times of uncertainty. Gold prices are under pressure, recently falling to a 2-month low due to a strong dollar rally. Spot gold dropped 0.2% to $2,568.69 per ounce, while U.S. gold futures declined. However, traders remain confident about a December rate cut, which could support gold prices. Rickards acknowledges that while restoring confidence in the dollar with gold backing doesn't require full support, the current gold supply is insufficient to fully back the U.S. dollar. Historically, partial gold backing, like 20% for Great Britain and 40% for the U.S., was considered sufficient. However, given that the U.S. holds about 261.5 million troy ounces of gold, valued at approximately $489 billion, and the total U.S. money supply exceeds $20 trillion, there is not enough gold to back the dollar at current market prices. To fully back the dollar, the U.S. would need around 272,430 metric tons of gold, far more than the global gold stock of about 212,582 metric tons. Transitioning to a gold standard, particularly during an economic crisis, would severely limit the government's ability to manage monetary policy, potentially leading to financial instability. Before we begin this video, please remember to subscribe to our channel and hit the bell icon so you never miss an update. Also, please share this with anyone who might benefit from it.
For a long time, go 5 or 6 years, I had I said gold could go to $10,000 an ounce, and recently I revised that upward to, you do the math, you can update it, but kind of $25,000 an ounce. I should explain what that is. It's not well, it will get there, but it's not a hard forecast like, buy gold because it's going to $10,000 an ounce. It answers a question. The question is, what would the dollar price of gold have to be in order to have the dollar backed by gold? In other words, whether you want a hard gold standard or a soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? And the math is fairly simple. We can do calculus, but this is kind of 7th grade math, or at least where I went to school. The money that does matter, the money that does drive the economy, doesn't come from the Federal Reserve. It comes from the commercial banks, and that's M1. It includes bank deposits and so forth. So I use M1, and then we know the amount of gold the government has, 8,133 metric tons. People go, it's all in Fort Knox. Actually, it's not. About half of it's, a little less than half is in Fort Knox. The rest is at West Point. There's a vault there. Can't disclose the location, but it's there. And people ask me all the time, say, "Hey Jim, who owns the gold? Is it the Treasury or the Fed?" And I say it's the Army, because they're both Army bases. I mean, West Point and Fort Knox are both. I mean, the legal answer is the Treasury owns it, but it's stored in Army bases. So M2, I don't know the number off the top, or M1, sorry, I don't know the number off the top of my head. You can just go to the Fed website. And 8,133 metric tons, break it down by ounces, divide one by the other, and one more assumption. How much gold backing do you want? Now, the hard shell Austrians will say 100%, if it's not, it's leverage, or, it's not a solid standard. Historically, that's not true. The Great Britain, backed up by the Royal Navy, ran a very successful gold standard in the 19th century. They had about 20% backing. At any given time, the Bank of England had about 20% backing for their notes. The United States used 40% backing. until around the end of World War II, and then they went to 25%. They ended up at zero by the late 1960s. But for it was either 40% or 25%. So take your pick. And the British were about 20%. That's what you need to instill confidence. So my math is take M1. Take 40% of M1. That's the dollar amount of gold you need to have a strong gold standard. Divide it by the number of ounces in 8,133 metric tons, and you get a number. And that number today is around $23,000. The gold supply is constant, and the money supply keeps going up. So again, fifth grade math, you're going to get a larger and larger number of dollars per ounce in order to back up a higher dollar amount with the same amount of ounces. So it's about $23,000. So just to be clear, that's not saying that gold is going straight to $23,000 an ounce. That's saying if confidence in the dollar were undermined and you had to resort to gold to restore confidence, you can't just pick a number. If the number's too low, it's going to be highly deflationary, which is what happened in the late 1920s. So what would the number be? And the answer is around $23,000 an ounce.
Rickards believes that silver will eventually follow the performance of gold. Rickards forecasts that as gold approaches $10,000 per ounce, silver could rise to $100, with intermediate steps like $40 silver likely to be reached sooner. This view resonates with current market trends. Recently, gold prices have repeatedly reached new highs, reflecting a growing concern over inflation and economic instability. As investors seek refuge from weakening fiat currencies, particularly in cases of runaway inflation, gold prices could surge past $5,000 and potentially hit $10,000. This trend in gold also influences silver, which has similarly seen rising prices this year. Analysts believe the imbalance between silver supply and rising demand will continue, potentially pushing silver prices to $40 or higher by the end of the year. Rickards has highlighted the differing dynamics between gold and silver during economic downturns. While gold prices tend to rise, silver may lag or decline due to its industrial demand. This divergence is rooted in both metals' distinct roles in the economy. Gold is primarily seen as a monetary asset and a safe haven. Silver plays a dual role as a precious metal and an industrial commodity, making its price more sensitive to industrial demand. Let's get back to the video.
I spent a lot of time analyzing gold, not so much I do invest in gold mines. I've been in gold mines and know a lot about the production side of the business, but my main interest has always been gold as a monetary asset. The truth is gold's not good for much except money. I think it's the best form of money. But you say, well, what else can you use gold for? Well, jewelry. Well, okay, jewelry is just a form of wealth that you wear. You see an Indian bride draped in gold chains. It's beautiful looking. Yeah, but that's her dowry. That's her down payment on the house. That's the kid's college education. So jewelry is just just a different way to store bullion. But so gold is not good for much except money. Silver is different. Silver is a precious metal. It can be a form of money, has been, and still is, but it has a lot of industrial input. So when it's an industrial input. So when you're analyzing silver, you've got the precious metals analysis on the one hand, but you have industrial input on the other. And that makes it tricky because if you're in a recession, let's say the price of gold is going up, silver will tag along. Silver will be along for the ride. And you're exactly right. It tends to lag and then it shoots up. But in a recession, silver is going to lag or even go down a little bit because of reduced industrial demand. So it's harder to analyze because you have to balance one against the other. On balance, the way I think about it is subject to timing differences. If gold performs the way I expect, silver is along for the ride. So you'll get to $40 silver, and sooner than later you'll get to put it this way: the world of $10,000 gold is the world of $100 silver. The inversion was a warning saying the recession is coming, but now that it's uninverted, it's saying the recession's here. In other words, intermediate and long-term rates are not going up a lot. They've gone up a little, but short-term rates are plunging. And everyone's saying, oh, the Fed's cutting rates. The Fed's going to stimulate the economy with rate cuts. Nonsense. I mean, the Fed is cutting rates, but that's not stimulus. That's a sign of a very weak economy. When did we have low rates? Well, the Great Depression was one, and we had zero rates from 2009 to 2019, which was a long recovery, but a period of very, very weak growth. Or average annual growth rate for that 10-year period was 2%. which is way below trend, which is closer to 3.5. So, and there are other signs. I don't need to kind of go through all of them, but whether it's technical signs such as an inverted yield curve warning us, and then a now uninverted yield curve, a normal yield curve telling us the danger is already here because rates are dropping at the short end. The First Bank of the United States, our first central bank from 1792 to 1812, had a 20-year charter. Don't think of it like the Fed. I mean, they didn't print money. They didn't create stimulus. They didn't try to regulate unemployment. They didn't have Humphrey Hawkins. They didn't do any of that stuff, which our current Fed does dismally. It was a pretty simple operation. It was supposed to provide liquidity to commerce on good collateral and good credit, and to the government, so that they could have a form of money that would get the economy moving. And they did, and it worked. It worked very well.
Gold remains a trusted store of value, especially during economic instability. On the other hand, silver experiences price fluctuations due to its dual role as both a precious metal and an industrial commodity. While gold continues to be seen as a reliable asset in times of crisis, silver's value is more susceptible to changes in industrial demand, leading to more volatility in its price. What are your thoughts on the role of gold and silver in today's financial system? Drop your thoughts in the comments below, and don't forget to like and subscribe for more updates. Thank you for watching.